Hey, what's up, everyone? It's Josh Flores from Wall Street Saturday. I just want to thank you guys for checking out the video this week. If you can, please support the channel by liking the video and subscribing. And I just want to inform everybody that everyone on this video are not financial advisors, nor anyone's financial advisors. Anything that's said or seen on the show is strictly for educational purposes only. With that being said, please enjoy the show. Hey, what's up, everybody? Thanks for joining us again for another week here for Wall Street Saturday. It's March 5th, 2022. It's the first Saturday of March, about to end Q3 here. But before we get too far, I'm just going to say a quick prayer for us here. Heavenly Father, we just thank you for this time that we get to come together, and just thank you for letting us be able to have discussions over the world that you have created and the situations that you placed before us. Help us be good stewards of that and be mindful of the gifts that you bring to us. I'm going to say in your holy name we pray. Amen. Hey, thanks, guys. And thanks for everybody who's joined us. I'm Josh Flores.
Misael Gonzalez.
And I'm Joshua Trusty. This past week, Bank of America actually published a note on the possibility of us entering a bear market. So I'm going to quickly share my screen and just talk briefly about why they think that is. So the Bank of America, in a previous note that occurred over the past week, said that they believe that the bull era of central bank access, Wall Street inflation, and globalization is ending. And in a bear era of government intervention, social and political polarization, Main Street inflation, and geopolitical isolationism is starting, according to Michael Harnett. And I think for us, this can be pretty concerning, because especially we think about globalization. That's actually been a huge catalyst for the GDP growth of the entire world. So, for example, if one country has some knowledge on like a particular work process and they share it with the rest of the world, overall the world in general becomes more productive, and that productivity growth increases the GDP and increases the stock market. There are also some other catalysts too that we've talked about in the past, like Main Street inflation, which basically just means like inflation that's occurring across the world due to supply chain issues, and also potentially due to the Russia-Ukraine conflict, especially with oil prices increasing. But like long-term geopolitical isolationism could put a damper on stocks' long-term growth, because if knowledge isn't being shared, and maybe some economies like no longer have access to each other, that can like reduce the velocity of money and reduce the amount of transactions that are occurring, and that would have a negative impact on the stock market. Because if you think about it, the atoms or the fundamental elements of an economy are in transactions. So if those transactions like aren't occurring, then the economy is not going to be as robust. And we've already discussed in the previous video that was recorded today that Russia has been removed from SWIFT. So that means that not as many transactions are going to be occurring in the global economy. And so, yeah, this is cause for concern, and we're just going to break down like our responses to why this could potentially cause a bear market, and like kind of evaluate what metrics we can look at when it comes to a bear market as well. So I think one thing to consider when it comes to evaluating globalization is actually the KOF index, and that is an index that measures the level of globalization, like in several areas. It can measure it economically, politically, and socially. And I'm going to show this chart, which shows the impact, how globalization has changed over time. So hopefully you can see it here. And if you look at this chart, over time, globalization, the KOF index has grown from around like 40 in its de facto index, all the way up to see, right around like 50, almost like 59 in present day. So if globalization like were to decrease over time, we might also see a decrease in the GDP. So this is one metric that I personally will be looking at over time, just to see what happens maybe this will be going down because you can see it's already beginning to level off due to some geopolitical issues that have been occurring over the past several years. So ideally, the level of globalization would just keep on increasing, but isolationism may cause this to level off and in fact decrease. So for example, in the past there were even reports of Russia trying to begin sealing off their internet. And there's also the Great Firewall of China, which exists, and so some content is also blocked as well. So the world is slowing down right now in terms of how how globalized it is, which could put a damper on some stocks. It's still difficult, I would say, right now, at least for me personally, to gauge what exactly this effect is going to be and when it's going to occur. But this, I would say, I agree with Bank of America in that that's one catalyst for, at the very least, reduced growth in the future. Any thoughts on that, from my colleagues here?
Yeah, I think for sure we are testing some waters that we haven't been in I would say probably 10 plus years. I have a chart also that I can share real quick.
Sounds good.
And that kind of shows what's happening, at least what has happened in the past, at least week, pardon the dogs. And if I can just get this going, hold on. Sorry. Okay. Sorry, team.
Dude, no worries. As he's kind of pulling it up, man, I think one of the things that I was thinking about, something that we talk about quite a bit, is just how important it is to look to other nations as they're developing as well. I mean, we've been very lucky and blessed to be living here in the U.S. and not very many other countries actually allow us the opportunity to be involved in stocks and being able to quote unquote increase in our own economy. I mean, people don't understand that when you buy a stock, you're giving money to the company, telling them to do what they want with it, and in return they're going to repay you, right, for your shares, right? That's why you hope that it goes up in value. And so not everybody in the world allows the opportunity for that to be the case. But as we search for those opportunities, and why I'm always trying to push for China, I think it'd be interesting to get into Europe. I know that we've talked about London and the UK being of great interest to us, but I think Interactive Brokers allows us the opportunity to invest in the global market. I mean, obviously you need to be aware of the time zones, right? So I mean, while we're asleep, the Hong Kong exchange is open, right? So I mean, if you want to trade stocks on the Hong Kong exchange, you might have to pull some awkward hours. But that's just one thing that I was kind of taking away, especially as we become more independent globally, right? I mean, everybody wants to be the best. I mean, we're in the U.S., so obviously we have a great pride for our nation, but so do the Chinese and so do the Russians, obviously. Some Europeans too. I think that they're a little more reserved about it, but I'm sure that folks in Germany have a lot to say about it. But yeah, I can let you take over, Misael. That's just something that I was just kind of thinking about as we were going through about that. Well, you're on mute, by the way.
And obviously this chart doesn't want to be seen. So anyway, basically it was just showing that, I mean, while the Dow has been on a downward trend, in the past few weeks, at least the commodities have been jumping up. I think in the past week, they're up at least almost 20%. And what we're seeing is, obviously we've seen that equities are at risk, interest rates are at risk. The only things that are not necessarily at risk, right, at least in pricing terms, are commodities. So let me explain that a little bit. As investors, we do want to see the price of the assets that we hold go up. And in terms of commodities, at least, I guess mainly wheat and oil, first oil, the supply is going to be greatly affected by this conflict going on in Russia and Ukraine. An example is, I heard that there was a tanker oil tanker that was offered $28 per barrel to unload the product. And we know that WTI, the West Texas Intermediate, is going for $112 a barrel. Now, you can see there that people just don't want to have anything to do with Russian anything. But if you're investing in commodities, then you know that the law of supply and demand says that when the supply decreases, your price goes up. And that's what we have seen recently in the past weeks. The commodities are up. So that's something that we have suggested, investing in commodities a little bit, because Russia is also one of the biggest exporters of commodities to the global economy. And so if this conflict continues, which it looks like it is going to continue, we may expect further sanctions that may even decrease the supply of commodities even more. So I think that's a play that we can, reach out to in the coming weeks so that we can capitalize a little bit on this move. Something else to keep in mind is if Russia were to be completely banned from the market in terms of oil, we would be looking at $200 per barrel of oil. So that would be like a 100% increase of what it currently sits at. And so, on Friday, the White House press briefing was saying, at least one of the reporters was asking, hey, how is it that, we're trying to fight Russia and sanction them economically, but we're still depending on Russian oil, at least in some part. I think they said 10%. So on one side, we're fighting them with sanctions, and then on the other side, we're funneling money to them at least at 10%, whatever we're spending. So one of the reasons why I think the U.S. is really dragging its feet in terms of trying to improve the prices for oil is that they obviously have a green energy agenda that we all know about. Biden is trying to push EVs. And so there may be an opportunistic way of achieving that. If we can continue to make oil more expensive, then there may be a push to find, for the capital to flow into those renewable energies that the administration has been trying to push for the past at least 2 years. So there's a little politics going on. There's a little bit of economics going on. But obviously, when you see interest rates and equities go down at the same time, when they usually are opposite of each other, that is sending some signals that we're in different waters, and we should prepare, or at least approach this thing differently. And I think commodities is the way to go.
Yeah, I just wanted to point out something in regards to like commodities, oils, things like that. I mean, if those who are still on the video, of course, and are been active listeners to what we do, what we're saying right now is like a very mature thing. The reason I bring that up is that we were looking at something, Josh Trusty and I were looking at one of these commodities before the call, and let me share my screen over here. I'll show you where I'm going at, why I'm saying what I'm saying is that obviously if you would have invested in this corn stock, which is obviously a commodity, you'd be up 21% this year to date, right? And I use year to date because it just seems like 2022 was the time where things were getting kind of crazy. But over this time, like if you would have invested it 5 years ago, up until, I mean, you would have done pretty well, but imagine just being around over here, holding it. You'd have to wait a very long time. So 5 years ago, you would have to literally wait until, let's see, right here, sometime before 2021, sometime in the middle of it, in March, right? So that's kind of a long time. And so what I'm trying to say is that if you're invested in a commodity, and same for me, I mean, we've been in Gush for a little while. I think that we need to know our exit there. Because it's not a thing that's going to be going on forever. It's not going to always go over, I mean, it might, right? Who knows? I mean, but for commodities, I think that those are a little bit more different when you're trading those. I mean, there's an entirely different exchange for commodities, right? Chicago, So I mean, those, and I think that a lot of those involve futures contracts. And so,
Well, I think if you're buying the ETF or whatever, like I was trying to share here, the iShares, it's particularly called the iShares S&P GSI Commodity Index Trust. I think you don't even have to know anything about commodities as long as you buy the ETF. Now, what I'm trying to say is that we're looking at, obviously, Putin is not the first time. This is not the first time that he's tried to, reduce the power that America has in the world, and we know that. So I think the same thing goes for China, right? And we've been talking about how this is playing out. I think this may be the start of that. And if we, for example, at least one of those examples is, let's say Brexit. Brexit is kind of like a signal of how countries are approaching their countries and their economies. I mean, it would have been better for them to stay in the common market, but they decided against it for whatever reason. And if again we see that, for example, Germany is the next one, right? They're obviously very susceptible to Russian, policy because they get like 70% of their natural gas from them. So you may see as changed, the weaknesses have been exposed in a fashion that is, very unique. And it would be like unwise for them to not do anything about it. And so I think that's going to happen here in the U.S. as well. But in the meantime, while the transition happens, right, from total globalization to independent, dependency on only like the factors that you have in your country, because of the technicality and the logistics, prices are going to go up, at least for the short term. And that's what I mean. So anyway.
Yeah, for sure. Like these geopolitical events have an impact on commodity prices. Because like the less globalized you are, that means like the more local you are, which can actually increase like the prices like for like the goods that consumers are going to need like for survival, like corn, wheat, like in local oil or what have you. So yeah, I definitely have some plays of my own that are in like in the oil and gas sector. Like similar to what Josh was saying previously, I'm definitely looking for my exit strategy because yeah, things are going pretty well for me like in those positions, but they won't go well forever it's mainly because of this particular catalyst. Like if you had invested in the corn ETF, you would not have been profitable for a long period of time, and that wouldn't necessarily be like the best long-term play. Like 37% over a 5-year period, the stock market generally will give you like around almost like the minimum on average like 10% per year. So you're almost losing out on like 13% there. So I think it's crucial not to just invest like for only like those like short-term plays where there's like a catalyst that'll benefit you in the short term. If you really are paying attention to what's going on politically, culturally, and economically, yeah, then that can make sense. But I think one of the best ways to invest is actually for the long term, so you don't have to worry about trying to time the market like you might have for something like corn. So my advice to you, as always, is to stay long and stay green.
What's up, everybody? Thanks for watching Wall Street Saturday. Remember, this is for educational purposes. We're not financial advisors. If you like our videos, go ahead and like and subscribe and hit that notification bell to be notified every time we have a new video out. Thanks for watching.